Ladies and gents, welcome to the final masterclass of this mini series. I really hope you've been finding lesson 1 and lesson 2 helpful so far. Big video today covering stop loss placement, entry criteria, risk management profiling, how I set my risk up to this day still that I find that pays me month after month. And so it'll be a lot to cover today, but it's going to be a really helpful video nonetheless. Now, I recommend if you haven't watched number 1 fully, number 2 fully, please pause this video and go and watch those first and then come back to this video just so it all makes sense and it's tying it all together, okay? Because I don't want you watching this video without the other 2 and getting to the end of this video and thinking, I'm not quite sure still, or there's a few gaps missing and so on and so on. So go back through chronological order and watch it all. But other than that, we're going to get into it and promises to be a final good lesson. So today we will be firstly going through just some myth busting around stop loss placement, because I think it's a subject I think is very, very poorly taught in the industry. And unfortunately, people are getting things very wrong, which is then meaning they're not giving their trade enough room to breathe before then price goes on in their intended direction. So we're going to do some myth busting around that first. So that will be very, very helpful. We'll then go into my risk parameters, my risk profiling, how I set that up and what I use to this day. You know, I'm now on 20 months on the bounce, profitable months on the bounce, the biggest win streak I've ever had in terms of monthly P&L. Yes, daily and weekly P&L has fluctuated within that, and we've had losing weeks naturally, but month after month P&L has been brilliant. And as you all know, if you've been watching me for some time now, I call every single trade live, always have, and I will always continue to do that for full transparency and to show you what proper, consistent results and professional retail trading actually looks like. So after that, we'll then go into stop loss placement. After that will be then take profit placement. How do we then get out of these hopefully winning positions? Entry criteria, how we get into these positions in the first place. And then as always with the other 2 masterclasses, we'll be jumping onto the charts and we'll be just showing you how I scope this up live. So again, you can tie all this prior information together and then put it into your live trading to implement straight away, so you can start making a positive difference to your trading P&L. So a couple of ground rules with your stop loss placement. Firstly, and this is advice you can always trust and double down on, this is one of the whole points of doing this masterclass, so you can lean on the right education and something that's going to eventually pay you long term in trading. Stop loss placement, each trade is unique, okay? Every single stop loss you place for that in particular trade is unique to that setup. So if you have been in the past or you've been taught that your stop loss needs to be a certain amount of pips every single time, 10 pips, 20 pips, 15 pips, 40 pips, whatever that is, stop that immediately, okay? The problem with using the same numerical value of a stop loss pips, if you like, is that that is not equating to where we are live with price and where you've maybe bought within that bullish leg, for example, or at that higher low region, okay? Every chart will differ, every asset class will differ in terms of price action, so it has to be uniquely tailored to that trade at that time. So there's a few things your stop loss placement needs to make sure. Number 1, if we're going to use a bullish example, if we are bullish, and as you know from the other series, we want to be buying from the higher lows, ideally, okay? Better risk to reward and so on and so on. That stop loss, and we'll go into the charts in a minute with this, that stop loss needs to be placed in a way, whereas if that RSP and if that 786 level gets broken about the fib that was in lesson 2, if those regions get broken, then your stop loss needs to equate to around that area. But at the same time, that stop loss also needs to make sure those areas have got room to breathe. So if price does decide to come in for an even deeper pullback, your stop loss isn't going to take you out prematurely before then price rockets in your favored and intended direction that you'd previously forecasted, okay? I always say a sign of good stop losses, when it gets hit, what did price then go on to do the day after and the day after that? If price kept melting away from you and going against your trade bias, brilliant. That's a great stop loss. It stopped you from losing more naturally. But if you're finding you're getting wicked out, tapped out by a few pips or 5 or 10 pips or something like that, and then it's going in your direction, that's a poorly placed stop loss. Now, Perfection doesn't exist in trading, okay? There will still be the odd occasion where you get wicked out, or it could be some huge amounts of temporary volatility. You get wicked out and then it goes in your intended direction. That's okay, of course. There's the odd moment, but it should be a rarity. It should be a rare occasion that happens. If you're finding that's happening even sometimes or fairly often, you're not managing your stop loss placement correctly. Okay, it's the same with a bearish example. If we're shorting from the lower highs as we should be from a risk to reward perspective, and it's safer, it's healthier, it's a better part of the bearish leg to get in on, again, your stop loss should cover the room above it to allow, let's say we're entering around that 618 region where prior structure was potentially, again, this was covered on lesson 2. Your stop loss needs to cover that room between the 618 and the 786, okay? It needs to be able to do that, because if price is well within its right to go onto that 786 level before then potentially dumping further, and that's okay. So you have to give it enough room to breathe, and to do that, that has to be a unique decision per trade, okay? So sometimes your stop loss might only be 16 pips. It might be 45 pips. It could be 55, 60 if a swing trade. You know, it could be just 8 pips. It really does depend. And I see all types of ranges on my trading. And as you guys know by now, I'm fairly more swing based. But I will see trades and stop losses that I have are 15 pips. I see others that are 50, 55 pips if it's a bigger swing trade. Okay? So you've got to get that part right. Because if you're going off of the same numerical value, you are doomed to fail. Let's get on to my sort of consistent risk profiling and what I do to this day. So a couple of non-negotiables. Every trade I take is a minimum, a risk to reward of a 1 to 3. So I always risk 1%, okay? Always, for the initial position at least. And my targets are always a minimum of 3%, okay? And I'll explain for a few reasons why in a minute. Now, if I have a lovely setup that I'm looking to take, and the risk reward is only a 1 to 2.4, say, I won't take it, okay? Because that is inconsistent. And you might think that's okay to take the odd trade like that over 1 trade or 2 trades here and there. But when you take trades like that and that eventually adds up to 50 trades, 100 trades, that can massively skew your data and eat into your P&L for both the worst, pretty much, okay? So it's really important, and this is why I do it to this day, it's really important that we always take a minimum risk reward of a 1 to 3, okay? The reason for this is for a few reasons. If for whatever reason I see a change in bias, price does something different against why I was entering the trade initially, so we see a 4-hour break of structure, something significant and something trustworthy that we need to listen to, then if my trade's running in profit and I need to manually close, now this won't happen often, but this is one of the benefits of having a minimum risk to reward of a 1 to 3. If I then need to manually close, I might be manually closing that trade for 2.1% or 1.9% or 2.5%. Now, as a partial or a manual close, that's not bad still. I'm still leaving with something a little bit decent. Yes, it's not the 3+%, but I'm leaving with something decent. And the problem, and this is why I don't like 1-to-1 risk to rewards, okay? Let me just clear all of this. Because if you trade a 1-to-1, by the time you put fees, commission, spreads, all of that side of things, especially if you're trading prop firms, even with FTMO, in fact, the most reputable long-term prop firm out there, their spreads and fees will still not be the best, especially their spreads at times, okay? So if you're trading a 1-to-1 and you hit 1% targets regularly, because 1-to-1 risk rewards tend to have higher win rates, is it actually a 1-to-1? No, it's probably a 0.9 or a 0.95 or a 0.85. So it doesn't, you're trading a negative risk to reward basically. And over long-term data, that's not good, because as you know, you cannot control your win rate. If you've been watching me for some time, you know I'm a big advocate for this, and that's not even opinion, it's fact. You can't control your win rate. It will fluctuate month to month, week to week, year to year, quarter to quarter. It will, quite simply. So that is why I focus on what I can control, and that is a minimum risk to reward of a 1 to 3 every setup, and that is consistent position sizing of 1%. Now, when it comes to scalings, Okay. The initial entry. Okay. So the initial, part of my handwriting, my initial entry needs to be running break even / risk free. Okay. So basically stop loss is just north of break even to cover my commissions for the trade. So if it gets hit, I leave with nothing, but I don't lose anything, of course. Okay. So break even. So for me to entertain a scale in, the initial position has to be running risk free. Okay. That's a non-negotiable. Okay. And my scale-ins are always 0.5% in terms of position sizing. Okay. So that way, when I do enter a scale-in, I never have more than 0.5% risk at any one point, which, as you can imagine, is really safe. I'm protecting my downside big time. And this is where so many traders fail. We all know how to have winning trades, but so many traders, when they lose, and it wipes out all their hard work, all their winning trades. And this is why they can't string consistency together, or one of the reasons they can't string consistency together. So that is how my risk profile works. Okay. The other thing to touch on before we get into then the technicals of stop loss placement, take profit targets, etc., is when do I go break even, or do I go break even? A lot of people will differ about this. But again, this is why I've made this masterclass, because then this is information you can trust and you can double down on. This is information I'm telling you based on over 11 years of live trading. I've got countless mountains of data, thousands and thousands of data points on this, okay? So it's trustworthy, okay? So I will only go to break even for 2 reasons, okay? Or when I go to break even, should I say, because I do move my trades to break even. Let's say we are in a bullish example here, and I've entered somewhere around there on that higher low, okay? Once that trade has done about 30 to 35% of its move, I will then move to break even on average, okay, based on what my data tells me. Because we are more swing based, higher time frame based, that typically allows for price to, on the lower time frames like the 30-minute, the 15-minute, the 1 hour, to still pull back without taking me out prematurely before then continuing on like that, of course. And obviously the 4 hours looks just like one more big leg, but you know what I mean with that. So if I just go back to that, so that's one way I'll do it. Now, again, it depends on price at the time. If we're fluttering around like this and we're subtly going up and up, I won't necessarily move to break even yet, because I'm well aware that price may still come lower first before it then starts swinging again more nicely, okay? So again, that is the other scenario. So let me just explain that again. So that might be a little bit confusing for people. So if we've entered somewhere like there, if price has done that, unless that's 35 or 40%, I won't be touching it, because price, as we all know, normal price action, is going to want to do that before it does that, okay? And that is where lots of people here get stopped for break even before then it runs into their targets, and they've got, their bias was right, but they get stopped prematurely. So I hope this is making sense so far. So that is how I will manage break-even trades. Now, if it's a risk to reward of a 1 to 3, I don't tend to move my stop loss into profit. It's very rare I do that. I put it at break-even at those 2 parameters, as I said, and I let price breathe and I let it do its thing, okay? And it'll be either then at that point a break-even outcome, or it'll be targets for 3%, 3.5, 3.25, whatever, you get the picture. One more thing to say before we get on to more of the stop loss placement is, when I say a minimum risk reward of a 1 to 3, that doesn't mean I take 1 to 10s and 1 to 12s and stupid things like that. No, because to do that, typically your stop loss will be very tight. And as you can imagine, you are going to incur a lot of premature losses that will eat into your P&L. What I do instead, most trades on average will be a 1 to 3, a 1 to 3.5, or 3.25, or a 4, 3.75. You get the picture, somewhere between 3 and 4.5%, which is brilliant, because for you prop firm traders out there, if you're passing that first phase, which is 10% typically, within 3 winning trades, you've pretty much passed phase 1, which is insane. 10% is a lot of percentage gain. Please don't forget that, okay? Remember what the hedge funds bench themselves off each year against the indexes. If hedge funds making 20% a year, they're fantastic. So just make sure you understand that bigger picture still in terms of what is realistic returns. Okay. Obviously, with retail trading, we can achieve higher returns than that, but still be sensible. Stop loss placement. Let's get stuck into it. So as you can see already, I've just pre-drawn a typical bullish market. We bought from the higher lows, everything covered in lessons 1 and 2. Okay, so go back and check that if you need to. So we've entered off here, okay, where that green is on that higher low. Okay, that's where the entry is. So in terms of a stop loss placement, I have to allow this space between this 618 and 786 level. I've got to allow that to be breathable, because price in its own right, if I just extend that box across like that in its own right, price a lot of the time will sometimes, tell it's a bit messy, price a lot of the time will sometimes wick down before then continuing on, or it will wick down before then having a nice body close around that 61.8 and then the move continuing on. Okay, so you've got to give that room in between those two fib levels, room to breathe. Okay, and this will be more, this will be easier to understand on the charts at the end of this video. Now, do we want our stop loss placement all the way down here? No, because it's then going to skew the targets. It then means we're going to have bigger long-term targets in terms of pip range, and that can sometimes be too unattainable in one go. So what we do want to make sure, though, is that we give the 786 enough room to breathe, say here. So again, if we do get some wicking into that 786 region, but then it body closes above, then we're going to be okay still. So we've given that, not only that actual line of the 786 room to breathe, but also a little bit just under it as well, because we know what price is like. It loves to wick before then that body close actually tells us what it wants to do next. So it's really important you cover that level below. And this brings me now to my next example. Okay, so if I just get rid of this, bear with. So let's say this fib level region here we've entered off is the 50, is the 50%, okay, of that range. Okay, this is again all covered in lesson 2. Now, if the 786 is down here, that is a big stop loss, okay? And in terms of upside target, we're going to need to hold it for a hell of a lot longer for me to get my minimum risk to reward of a 1 to 3, okay? So the reason, okay, let me put that back on. The reason, let's just redraw. Ooh. If this is where the 61.8 lies, okay, our stops always as a caveat to this, and this is the beauty of positive discretion, our stops have to cover that level between that next level. So if I've entered around that 50% region based on entry criteria, which we'll go into in a minute, I've got to make sure the room between that 50% and that 618 is breathable. Because again, for the same reason I said earlier, the wicking, the choppiness, the noise, okay? Even the 1 hour and the 4 hour can be choppy sometimes. So God forbid what the lower time frames look like as well. Do you see what I mean? Okay, just check that mic still going. Yes, it is. Now, if it's a bigger swing trade, yes, we can afford to maybe have deeper stops because the targets are a lot higher, okay? But typically, with most entries and most trades I take, you've got to make sure the fib level below from where you've entered has room to breathe, and sometimes even just a little bit lower than that, again, for the same reasons we said earlier with the wicking. So you can see this is why stop loss placement is very particular to each individual trade, because sometimes I might enter off 50% of the range, sometimes I might enter off 61.8% of the range, okay? Even sometimes a 786, which gives me an amazing risk to reward, okay? Rare, but does happen. So you can see what I said at the start about myth busting with stop loss placement, because if you just use the same 10 pips, 20 pips, 30 pips, you're going to get stopped very easily and very often, and you are going to go on some horrible losing streaks for the wrong reasons. Losing streaks are natural, yes, but those losing trades should always be optimal, and you getting tagged out prematurely on a stop loss is not an optimal setup because you have failed to give it enough room. Too many traders out there try and get nice tight stop losses. They get a massive upside and they just get tagged out all the time. It's not trading. You're just gambling. You're trying to just hope that your timing is spot on that as soon as you enter, price goes in your direction. Trading doesn't work like that, okay? Expect to be in a bit of drawdown before then price eventually plays out. That's life, that's normal, that's healthy. If you can't get on board with that, trading is not for you. And I'm just being brutally honest, okay? Because it's a savage enough skill to learn in the first place the right way, and it's even more difficult to stay consistent, okay? So this is, again, another reason why I've done these masterclasses, to give you some very trustworthy, doubling down information that you can take away. Now, on to take profit placement, okay? So remember, quick recap. If we are measuring the range of this leg because of the fib, okay? And remember, that's obviously on the 4 hour of the daily, a very, very trustworthy time frame. Let's say this is the 61.8 here, okay? Now, in terms of take profit targets, the beauty of a fib, yes, it helps us identify where price is most likely to trade into in terms of pulling back naturally before that next formation is, or that next bullish leg is played out. But it also helps us distinguish target taking as well. And I find, again, over my long career so far in trading, the minus 27% and the minus 61.8 get hit more often than not. So this here would be the 0% of the fib, okay? That's the top of the leg that you've measured initially to measure the range. Up here somewhere will be the minus 27%, okay? I put my fib settings on the other video, so go back and check those and make sure you've copied them properly. And then somewhere up here as well, you'll have the minus 61.8, basically, okay? So what I would typically aim to do is, I will always aim to try and target the minus 27% first. That's if it allows me to get my 1 to 3, okay? Sometimes I can get away with just targeting the 0% because I actually took an entry down near that 786 and I can afford to get that 1 to 3 off without having to trade into the minus 27%, which means a smaller pip range. I can get in and get out type thing, and less time in the market. So it means we might not be holding through news, for example. So if that works, it can work. But if we go back to that 618, most trades I will run into the minus 27% initially, okay? Some trades I may extend into the minus 61.8 if it's looking good, or let's say I've bought off the 50% instead. Sometimes I may need to run that into the 61.8 to get my risk reward of 1 to 3, whilst obviously giving stops enough room to breathe, okay? So again, it will vary, but I never I'll never set my targets anything other different than then. So either the 0%, the minus 27, or the minus 618, okay? It will always be one of those three, okay? What we talked about earlier with manual profit taking, doesn't happen very often, but if it does, it's for the reasons we mentioned earlier. So there's nothing more to my take profit target taking. That's it. People say about taking partials. I don't do that. If I have a winning trade and it's scalable, as in the pip range is long enough, big enough, so maybe a pip range over 80, 90, 100 pips, then I can look to scale in, okay? Which we'll cover now. I know we've already mentioned scale-ins gradually, okay, already. But for example, again, if that trade runs in our favor, we've then had the pullback, confirmed higher low within that bigger bullish leg. And then that's then at this point here where I can then look to scale in. But the stop loss on that scale in, okay, this is really important. The stop loss of that scale in goes to where that initial entry was. So remember what I said earlier. My initial entry has to be running risk-free first to then have a scale in. So when I take that scale in off that smaller higher low, if we're bullish, so that smaller higher low might be the 30-minute or 1 hour within that bigger 4-hour daily picture. When I take that scale in, that stop loss is where that initial entry trade was, okay? So again, if that stop loss gets hit, my initial trade gets taken for break even, and obviously the scaling loses me 0.5%, okay? So again, tying it back to what we said earlier about scaling into winning trades. There have been times where I'll scale in more than once, but they are fairly big swing trades. Most of the time it will just be one scaling maximum, okay? Because we never are 100% guaranteed on what price is going to do. And again, it's more of just a risk management play, protecting my downside and just making sure there's not too much noise going on and there's not too many decisions to make. Because really with the way my strategy works, when I'm in a trade, I've got one decision to make, two max, when I go to break even or when I maybe exit if I need to. For example, if, like I said earlier, something's changed on the 4 hour, but it's not always that. It's normally just one decision. When do I go to break even? So life's easy. It means you're less emotional. You can be away from the charts. You're not watching price like all of you 1 minute, 5 minute traders do. You're seeing every bar print and every candle print, and it's making you second guess things when it starts pulling back. And should you manually interfere? It's messy. Over a case of 50, 100, 250 trades, it's really messy, and it eats into your edge if you even had one in the first place. So this is why I love this. It's simple, it's clear, there's clarity. You can be hands off. You can go about your day and do whatever you want to do, and you just need to, regularly check, if that though, because all we care about when these trades are running live is, what's the next 1 hourly candle done? What's the 4 hour close done? Is everything still looking good on the index and in the individual pair? Brilliant. Phone away and crack on with your day or whatever you were doing. So it's really, really helps with this and keeping you very level grounded, very non-emotional, and keeps your decisions based off strategy and your system and your edge and not emotion. Okay? That makes a massive difference between what I see losing traders, break-even traders, and profitable ones. Okay, last but certainly not least is entry criteria, before we then get onto the charts to pull all this knowledge and theory together onto live examples. Okay, entry criteria, interesting one, okay? It's not one particular thing, and this is the beauty of the strategy. It's a few different factors, okay? So entries for me will typically, most of the time, either be on, let me get my pen sorted, the 30-minute or the 1 hour. Now, as you guys know already with my teachings, the lower time frame you go, yes, price is fractal, but it doesn't mean it's all the same in terms of trustworthiness. This grinds my gears when I hear people say price is fractal. Yes, it is. That's true. I'm not saying it's not, but time frames, the lower you go, the less trustworthy they are, the less noise there is, the less false signals there are, the more false signals there are, okay, and fake outs and all those things, whatever you want to call it. So the 30-minute, the 1 hour, I purely use for entries, okay, coupled with the 4 hour as well, which I'll explain now, okay? So let's say we have marked that area of interest out. Oh, crikey. We've marked that area of interest out, okay? Let's say we're in a bullish sequence and we're buying from that high low. Nice, easy example, okay? Really common. What we want to see in terms of around that area of interest. So let's say that's a 4 hour / daily area of interest, very highly confident, very trustworthy, all the stuff we've already covered. So look, like I said at the start of this video, go back and watch it. What I want to see between the 30-minute and the 1 hour, and ideally the 1 hour because it's slightly more trustworthy than the 30-minute, I want to start seeing slowing of momentum, okay? Momentum. I then want to see wicking, okay? And I want to see smaller volume, okay? So what this means is this. Let's go back. What this means is wicks that maybe, look, remember we're bullish in this example, like that, okay? So they've shown exhaustion downwards. They've shown buying pressure. Obviously, if these candles are printing on the 4 hour as well, we're laughing because, again, the 4 hour is even more trustworthy. That's 4 hours worth of price as well. If the 4 hour looks something like that as a candle, you can imagine the 1 hour and the 30-minute are looking very, very wicky, okay, and slowing of momentum. It's what we want to see. We basically want to see price around that area of interest, okay, price around that area of interest there, slowing. So we see bodies, slowing around like this. There's no massive body closures lower. We want to basically see price stalling, ranging, building a base, obviously, if we're bullish, or building a top if we're bearish, okay, at that lower high in a bearish example. Wicking, smaller bodies, smaller volume. Then this is the important, well, it's all important, but this is the important part. We're still recording live. Yes, we are. This is the important part. We want to make sure then, let's say we've seen, bear with me here, guys. Let's say we've seen quite a few wicks on the 1 hour, the 30-minute, and the 4 hour, for example. We then want to see a candle that shows us really good volume. Okay, so this is the last bit of that before we enter, that the market has said, yes, we agree with your area of interest. Yes, we agree with your bias. And then we see the push away, which indicates that. Okay, now for me, that can be 30-minute, 1 hour, or 4 hour. Okay, it can work on all of them. It depends on the type of trade. Is it more of a day trade, a 50, 60 pip range? Is it more of a swing trade? Okay, so that can work. And what we basically want to then see is once we've had that push away, for example, on the 30-minute or the hour, it's done that push away from that area of interest. We then want to wait for that temporary 30-minute or 1 hour pullback. It might just be a wick, for example, and that's our entry in there. Okay, so, and again, it will vary, and again, it depends on the type of trade, but that is the entry criteria as a whole. And what lots of people fail to understand is that when you get to that area of interest, people say, right, I'm buying because price is there and everything else is there and all that synchronicity we've talked about in the other lessons. Yes, that's all well and good, but you're still jumping the gun, okay? Because price hasn't slowed, it hasn't wicked, you're just buying because it's hit that area of interest in the market. Market actually hasn't showed you at that point that it's slowing, it's wicking, and that it's actually going to reverse and that next leg's going to happen to continue with the trend, okay? So this is why I'm not a fan of buy orders or sell orders where it gets triggered on behalf of you, because you'll get tagged into trades that in hindsight on your journal, you'll look back on and go, there was no entry criteria. I wouldn't have entered, okay? Because it just kept melting through your area of interest. Areas of interest sometimes will get completely disrespected, but that's why we have entry criteria. So you can still make that live conscious decision to go, that's not respecting it. That's hands off. It's a shame, but that's life. You're not going to be right every single time, okay? Win rate, I don't care about, okay? So you got to wait for that final confluence, which is the biggest confluence of them all, that the market agrees with your area of interest and it agrees with your bias. And that's then when you can pull that trigger and get involved. There's nothing more to it than that. But I have this criteria in place, so it makes sure that you are entering the right trades, but it's also giving you a lifeline and a chance to go, I can't enter that. It's a shame, but it isn't respecting my area of interest. So I've got to be hands off, and you've either got to wait for more entry criteria or it's a trade that we just stay away from. Okay, so I hope that helps. Let's get on to the MacBook. Let's get some live examples up and bring all our knowledge together. Hey guys, so obviously back onto the chart so we can bring this all together with what we especially talked about with stop loss placement, entry criteria and targets. As you can see on the fib, the two targets are there, -27 and the -618. So at the moment, just for context, the weekly, daily, the weekly and the daily are bullish on gold. When we look at, and this is the daily, most recent daily bullish leg, okay? And if we go onto the 4 hour, we can see at the moment we were bearish. This is the lower high, okay? We've come and tried to put in new lower lows. We've failed. We've basically made equal bottoms there, and now we've pushed higher. Now, we haven't quite broken above that RSP yet. So the 4 hour is still technically bearish until I see that RSP broken above. So this would still be hands off, okay? Because you've got to be patient, and hopefully this just shows the step-by-step where you just need to be patient. Let price do its thing. Trade what you see, not what you think. Because price at the moment, the 4 hour and the daily, has come into this area of interest. But the 4 hour hasn't quite turned bullish again. So we're back in sync across the 4 hour, the daily and the weekly. So at this point, I've got to wait for that break. So let's just see if we get the break or we come lower. Brilliant. We get the break here. So upon seeing that 4 hour close, okay, upon seeing that, that is then the beauty of dropping down onto the 1 hour, okay, or even the 30-minute. So we would want now, if we look at 30-minute price, we were obviously consolidating and bearish. We broke out here, that market reaction I was talking about earlier on the iPad. It breaks out. We have the pullback, okay. So again, which proves that the fibs work. Look, we measure that leg. Can you see how we've tapped into the -27%, okay? So now that leg may finish because it's hit targets. We can then just delete that fib. And again, I know we don't use fibs typically on the 30-minute, but it just highlights how price can swing quite nicely, okay? okay? So we're just then looking now, ideally, if we can get the 30-minute anywhere within this region here, that would obviously mark out a typical higher low. We know we're sort of the 4 hours just turned bullish. We know the daily's bullish. We know the weekly's bullish. So we're just looking for a pullback within that 30-minute or 1 hour price to get involved, because price has already shown us now we have turned bullish on the 4 hour. So we're respecting that area of interest on the daily. And the 30-minute, the 1 hours you've just seen here has pushed away and given us a reaction from this region here or this region here, okay? So if the 30-minute pulls back, let's just get rid of that. Let's go candle by candle. So we might push higher. Let's see, do we bottom out? Right, so there's one potential wick. Not quite low enough for me, let's see. Good. So for me now, at this point in time, I would be now, so this would be 7 a.m. This is just before London. I would now be entertaining this. This for me is fine. And people might say, but that candle looks bearish and the volume on it. I say, but no, forget that. Remember where you are within price. Remember what's got you to this point in the first place. The synchronicity, all the things on lessons 1, 2, and then today's lesson number 3. So I don't mind you buying this. Again, forget the color. Color has nothing to do with trading in these candlesticks. It's about the wicks, about the body size, the volume, the aggression of it, the volatility of it. The color's irrelevant, okay? I don't mind what your colors are on the charts. So for me now, after seeing this 30-minute pullback, I'd be looking to take this. And now this is where it gets interesting. If we go, we'll just pull targets up for a sec. Let's go back onto the 1 hour. So remember, where have we got to cover? We've reacted off that 61.8 region on the daily. We've had the push off. Now the beauty of this is because we've had the push off, we maybe only need to cover that most recent leg, like so, okay? So as if price did decide to come slightly lower on the 1 hour into around here, maybe form some equal 1 hour lows where that bullish leg started from, then we're still going to be okay, all right? So this is a great example of more potential how we get involved on a 30-minute and a 1 hour. And then we can either look to target the lines here. So this is the 0% of that bigger, higher time frame fib. That's the minus 27. So if we then look to roll that into there, that's already a 3.15. So that is fair game. And we've not, in this example, had to have our stops down here because actually we've been patient and we've waited for price to actually react from that higher time frame area of interest on the 30, on the 1 hour, and on the 4 hour, because that flipped bullish, remember? So we don't necessarily need stops down there as long as we cover these lows. So if price did come for a deeper retracement, we are still okay. Okay, so let me pop that back to the 3.15 that it was. Okay, let's just see, does that then play out for us? So we come back in and test it. Drag that across. Brilliant. Do we get there? Yes, we do. And do we? Eventually we do. We go into the minus 27% as well, which would have been a 5%. Crazy. So you can just see the importance of just waiting that little bit longer and being patient. If we go back onto that 4 hour, again, once we saw that 4 hour turn bullish, that candle there, remember, you can see how we came for a pullback on the 4 hour. So you could have even had a 4 hour entry because look, we did tap into the 786. But as I said on the video lesson earlier, okay, we tapped into that 786 and respected it. So this is why you've got that stop loss based on the trade itself. This is why it has to be unique. Because you could have taken this from a 4 hour perspective, okay? If we'd taken the entry, say here, stops obviously would have had to cover the 786 and cover maybe that most recent higher low prior to that RSP. So we're covering there with those wicks. That gives us plenty of room. And if we then still target the minus 27% of that, look, that still gives us just about our 3%. So it's totally, totally doable. And if we're running quite nicely and there's good volume, we can have this running risk-free. Why can't we target the overall 0% for 3.8 and beyond? Okay, remember that's a daily fib we're working within still if I just show you. Okay, remember that's the high-low region area of interest. So it can really work if you get grips to this. It's a fantastic, I'm biased of course, but it's a fantastic strategy. But this is another reason why I call every single trade live. So it proves performance, it proves how good the strategy is in all market conditions. A lot of people have been complaining about 2025 price action, and I say it's been fine, it's been normal, it's cyclical, it's typical market conditions. People need to get on with things. But unfortunately, the lower time frame type strategies, your 1 minute, your 5 minute, your ICT stuff, it's not hugely adaptable. There's too much noise down there, okay? So trading with the trend, more swing based predominantly, is the way to go. And that's just hopefully a good example of where patience pays, and culminating a daily area, a 4 hour area, well, a daily area of interest, waiting for the 4 hour to flip so it's all in sync, 4 hour daily, weekly. And then how to get involved from a 30-minute/1 hour entry criteria perspective to then take a trade like this. So gold gets a bad rap for people say gold's very difficult to trade, and I actually say it's not. It's a brilliant asset class to trade, commodities in general. But gold and silver are brilliant to trade. It's just too many people are trying to scalp it, and it's too noisy and too volatile lower down, okay? Price needs room to breathe. Gold's a fantastic thing to trade. I probably take 1 to 2 positions a month on it. It's really, really good. And a lot of my traders are also the same. They've really nailed it. So guys, I hope that gives you a fantastic example. Guys, thank you so much for watching. That does wrap up, unfortunately, the masterclass series. So I hope you found it really, really helpful. Hopefully it's given you more structure to your trading, and hopefully it's given you more of a system and education and knowledge you can truly, truly double down on and trust, okay? These are the same rules I stick to this day. And I've done this series as well because, as you know out there, there is so much noise, so much poor education, so much intraday scalping, 1 minute, 5 minute. And although that may yield you very short-term results and lure you in that way, in that instant gratification, it doesn't, in my opinion, have longevity. If you look at the data coming out of prop firms, you look at the data coming out of institutional funds, it doesn't work in the long term, or it's incredibly difficult to make it work in the long term, okay? You're better off going more swing. You're better off going more 1 hour, 4 hour daily, weekly, all the stuff we've covered in this masterclass. If you want more tailored help, book a call below or drop me a message on Instagram and we can get some mentorship options going for you. I offer 3 months worth, and I also offer 6 months worth depending on your need and what would suit you best. Guys, as always, I do appreciate everybody watching this. Please drop a like if you can. It massively helps me get this education and channel in front of more people so I can help more people the right way so they can navigate this very difficult skill that is trading. Guys, thank you as always. Take care, and I will see you for my next series, which will be how to trade a 200K FTMO prop account. And I'll take you through all of stage 1, all of stage 2, and also hopefully the funded account itself and a payout. So you can see how I would navigate challenges like that. Guys, as always, take care.